Happy New Year, everyone, and welcome back. Welcome to this 2020 year. I hope that you are passing great days with family and that you had a wonderful New Year Eve and you're enjoying these days. I also wish you a great 2020 with good health for you and your family and lots of success and fun for this year that is beginning today. So today is 1st of January, so time to do a recap on the portfolio for the last 6 months, roughly 5-6 months since August when I started this this investment portfolio. So for those of you that are new to the channel, what you are looking at now is a Google spreadsheet that tracks the investments that I'm doing in stock, okay, in the stock market, and how they are performing, and how much dividends these stocks are paying me on a monthly or quarterly basis. So today I want to talk about 2-3 things, okay, different topics. One, we will do a review of the portfolio. I will ask you a question on what is your opinion on if it's better to pay your mortgage early or continue investing. What is your point of view on that? And sharing with you what are my thoughts for this year with the portfolio. What are the ideas that I have, because there are some things that I might want to change. So I will share those up with you. So let's go to the dividend tracking, because December has been a phenomenal month. As you can see here, I got paid 338 euros just in the month of December, which is a 208% increase from the previous month, November. Okay? And the purpose of all of this is to build wealth through time and build a flow of passive income through time. So at one point in time, this portfolio will be making more money than myself working. So the important thing for me is that this graph is continuously growing. Okay, as you can see, it began a growth tendency since August, when I started investing heavily in the portfolio. Until then, I was just owning 3 stocks, okay, and only one of those was paying dividends. And as you can see also in this graph, the portfolio value has grow steadily every month. Okay, I'm adding and pouring money to this portfolio. So, sorry, coming back here, almost 400 euros, 340, sorry, for a month. That's a lot of money for me. In a month, earning that amount of money without doing anything, I mean, not working actively for it, it's a huge amount of money. It's much more money than comparing of trading your time for work, okay, to earn that kind of money. So if we go to the holdings again, the portfolio value has increased to 102,000 euros. Okay, this is taking into account the current currency levels compared to the dollar, because all of my stocks are in the US stock market. So I've invested 98k euro, and if I would sell today the portfolio at this price per dollar, okay, this would be the value of the portfolio. But as I plan to keep it for the coming years, if everything goes good, I will not sell, or I will not decrease the amount of money that I have in the market. Maybe I will sell stocks and buy other stocks, but the amount of money in the market will increase. So the important thing for now is these numbers in dollars, okay? And the performance for the last months since I started investing in this portfolio has been around 5%. which is not great, but it's not either bad. For a 5-month return, I think it's quite good. Okay, this is not taking into account. Sorry, this is taking into account the dividends because I have reinvested all the dividends. And if I go here to compare with the market with the S&P 500, okay, this is SPY, okay, this is an ETF that tracks the S&P 500. If we look since August, let's move it right here, we can see that the market has gone up by 6.57%. In this year it has grown a lot more. If I could click here 1 year, sorry. In the last year it has grown 28%. But as I got heavily invested and I came into the market in August, okay, we can see that the performance for the same amount of period has been 6.57%. And this opens to me some ideas and changes that I would like to make in the portfolio. So I've built out this nice graph to see how much weight I have in each of these sectors, okay? And I would like to put a good amount of my portfolio in index funds, okay, tracking the S&P 500 and the emerging markets, to own also all of the market and have it more diversified. I mean, a chunk of the portfolio, like 20%. And I was studying this and analyzing it, and the problem I'm facing again, and it's a problem that we face in lots of countries in Europe, is that all of the brokers are charging big fees or high fees. So it's not a big fee if you are investing a huge amount of money just once. But my point of view is that the market grows, okay, and we can see it here if we go back to the graph. It has some ups and downs, but imagine that if you only invest a huge amount of money here, okay, instead of doing it here, the risk that you are putting is more, and maybe the amount that of money that you earn is less than if you are dollar cost averaging and you are investing month by month, okay? So in that way you are buying at an average selling price, okay? So you see a more steady growth, okay? Instead of maybe a big growth or a big drop if you are trying to time the market. And the problem that I'm facing is that the broker, as I said in my previous videos, I'm working with two brokers. I work with Revolut Trading, which only lets you invest in a portion of the American market, in some American stocks, not even the full S&P 500. And it lets you do it for free. They only charge you a custody fee per month, which is pretty small. So it's like free trading. So the commissions are very low. And I have the rest of my portfolio, roughly 50k euro in ING. And ING charges 20 euro for each trade that you do. So that means that if I was to monthly invest, let's say 500 euro in an index fund, I would be paying 15 euro each month for each trade that I do. And to me that's too high, okay? So I've come to the conclusion that for the following months, until that changes or a new broker appears or Revolut maybe introduces index funds, I will continue to try to build this portfolio with a diversified portfolio in different sectors for the fees, okay? I'm thinking also on changing a little bit the strategy. So mainly the portfolio is based on stocks that pay dividends, okay? This is what I'm tracking, what is the estimated dividend amount that I would earn per month. Okay, but I think that also is interesting to be invested in growth stocks that maybe they don't pay dividend today, but at least I would like to have a small amount of my portfolio in those kind of stocks like Amazon or other kind of stocks that I think are going to continue to do very very good in the following decade. Okay, as the investment is a long-term thing in my opinion. So roughly during these 6 months, I've been, I think, making some mistakes on the way I've been investing because I've been investing in the stocks that I thought could be growing more in the following months, okay, or the stocks that were cheaper at that point in time. And really, for example, Apple has surprised me and many other investors like me that are not experts, okay. This has reached all-time highs during the last 4 months all the time. And it is the stock that has grown the most in all the portfolio since I bought it. So I think that in the long term, you get I mean, it's very difficult to try to guess how the stocks are going to perform and how the market is going to behave. And it's easier to do a dollar cost averaging. I think you have more chances of enjoying, I think, a more steady growth or average growth of the market, okay, and balancing the portfolio in terms of the percentage that you have weighted in each of the sectors. I would like to know what is your opinion on this. If you are watching this video, what do you think? So if you can leave a comment below, please, in the comment section. If you are a promoter of the dollar cost averaging and putting money in all of your portfolio, like if this is your own index fund that you have built, okay, which is my case, or if you are maybe investing only in 3-4 stocks every month that you think that are cheaper at that point in time. I would like to know what is your opinion. Okay, but my idea is changing after these 5 months of heavily investing and analyzing and reading a lot and seeing how the market behaves. So my way of thinking is changing, and next month most probably I will put money in all of the stocks. Okay, even if some of them are at an all-time high. Okay. So this was the first part of the video. Again, as I said, to me, 338 euros for the month of December in dividends paid is a huge amount of money. Sorry for that. And my target for the end of 2020, I still haven't defined a specific target, like analyzed it in much detail. But I think that growing the portfolio to 150k euro, it would be a good target as a minimum. So I will try to reach that number. And two things that I wanted to share with you also, and this is some doubts that I have, and this is the other question that I make to all of you, and I would like to know what is your opinion on if it's better to pay off your mortgage early, okay, it's a situation where we are paying very very low interest for the credits in Europe, okay, also in the US and the rest of the world, but especially in Europe, or continue investing because normally you are going to get a more return from putting that money in the market and just paying your monthly payments for the loans that you have. And I want to share with you the current situation because I think I did something that was not efficient in December, but it also gives me a peace of mind. I put some money on my mortgage, okay, to pay off early 15k euro that I extra earned there this last month instead of putting it in the portfolio. And I know that it is not the most efficient thing to do, but it also gives me a peace of mind that if anything happens with my job or something bad happens, I have a lower payment and I have less months remaining in the mortgage, okay? So right now I have 9 years left of mortgage, and I pay an interest of Euribor, which is an index for credits in Europe, okay? Plus a variable, sorry, this is variable, Euribor is variable, it goes up and down. It has gone down the last years. Right now it's negative, it's below zero. And I pay that plus a 0.99%, which effectively as of today, it's an effective interest rate of 0.7%, which is like almost free money, okay? We would say for investing. And I also have a car loan at a fixed rate. This is a bargain credit that I got because the car manufacturer is entering was entering the Spanish market at that time and was creating a huge great deal for financing the cars with a fixed rate of 0.25%. So I prefer to put more money into buying my home at that time because I bought a home and a car at the same year, 2 years and a half ago. And I decided to finance most of the car because it was a more efficient decision. So I would like to know what is your opinion on this, because for me it's a win-win. I mean, it's just asking, is it good to take this good decision, or is it good to take also this very good decision? I mean, both decisions I think are good, because paying off your mortgage earlier when you also have another loan, it gives you peace of mind and it gives you more money, more free cash flow every month, okay, and give you, I think, more insurance or peace of mind in that case, more security. But I know it's not the most efficient thing to do when you are investing, and easily you can make much more money than 0.7% of the costs of the mortgage. We would need to consider also the life insurance that we must pay, in my case, mandatory with the bank that I have the loan, and the home insurance also. But I would like to know what is your opinion on that. So just to summarize, yeah, I would like to know what is your opinion on introducing also some growth stocks that maybe they are not paying dividends or are paying very low dividends. Like for example, Apple is currently yielding 1.1%, which is too low of a dividend, but in exchange the stock is growing much more than the rest of the portfolio. Okay, so I would love to know your opinion on that. And for the weight on each sector, okay, I'm going to rebalance this, and I would like to lower the technology part to 20% and compensate on the healthcare, okay. So most probably I would like to have 20% on real estate and 20% on healthcare and technology, and the rest to be the 40% remainder to be split it across industrials, finance, consumer, and entertainment, okay, which are the less number of companies that I have right here, okay. Most of the companies that I have are real estate and tech companies, to healthcare, which are companies I think are doing quite good. I also forgot to mention that we had two newcomers into the portfolio, which are Digital Realty Trust, and I want to talk about this one, okay, and the other newcomer is LTC Properties. Both are real estate companies, and I want to talk about Digital Realty Trust. So let's go over here to Seeking Alpha. So Digital Realty Trust is a company, I don't see here what is the profile. of the company, but it's a company that specializes in buying spaces and renting them for data centers, okay, for IT companies and renting those. And I think it's interesting because as the cloud is growing more and more, it's true that a lot of companies are moving to Amazon and Microsoft Azure and Google, but also there are other companies that won't be in the public cloud, and maybe they want to host or to rent the space where they are going to allocate their data center. And it's an interesting company for me. In this case, they are paying a dividend of 3.61%, which is a bit low for a REIT, but they are only paying out a 65% payout ratio, which is low for a REIT. I mean, they have a room to grow this dividend, and they have a dividend growth of 14 years. So if we go to here, dividend history, and we click here in all, we see that they have steady growth since they began in 2005 to pay dividends, which is what I want to see for my portfolio. I want to see that my payments every month are growing and growing. As this is a long-term investment, I'm not so worried in the short term of how the stock is performing or if it's growing or not. Okay, so we can see here in 1 year it has grown, but has ups and lows. But if we go to 10-year space, has grown a lot. Okay. So yeah, I wanted to share with you these two newcomers, which are real estate companies, LTC Properties. I think they pay dividends monthly. Let's see here, LTC. So yes, they pay monthly. Okay. So this will help funding the portfolio. It has a higher dividend yield than DLR, which is a 5%. Okay. And I bought this company just to balance a little bit more the portfolio, and I will be buying more stocks of this company. Right now it's only 0.39 of the portfolio. Okay. But I want to balance out from EPR, which is right now 9%, almost 10% of the portfolio, and Simon Property Group, so I can diversify a little bit more inside the real estate business, because these are different companies that invest in different type of real estate properties. Okay, different types. So that would be interesting for me to have this diversification in the portfolio. Also, for the next video, as this one is taking a bit longer than usual, we'll share with you what have been the new features that are in the Revolut Trading app, because they have rolled out more stocks available to purchase, and also small new features. Okay, and that will be something for the next video. So if you want to comment, please leave a comment on the video. You can also reach me at passiveincomeevolution@gmail.com. You can send me there any question that you have, or any suggestion, or any ideas that you have for the channel, or something that you don't like, or any opinion that you have, so we can discuss and debate, okay, in the next videos. And that's all. Thank you everyone for watching and for following the channel. And I hope that again that you have a great year. So take care and enjoy these days. Bye bye.